All right, so good morning, everyone. Just settling into the technology here. Simon, have you got your video working, and Vernon as well? Uh,
Yeah, sure. Yes, I hate Zoom. There we go.
Morning, Simon.
Uh,
How's it going? Hi, Vernon.
hey, how's it?
Good, how's it?
Yeah,
No, Gareth, that
good.
was very fancy. We had some tunes beforehand.
Yeah,
Like,
well, we're getting some things right and other things wrong, unfortunately. Uh, yeah, good morning and welcome to all of our guests this morning. We've got quite a few still filtering in, um, and I'd like to welcome Simon Brown and Vernon Vessels, a couple of from Just One Lap and Currency News, respectively. I'll let them introduce themselves just now. And then I've also got my colleague Narina Fisser on the line. We're hoping to have one or two more other ones of our friends. I think Davron, I think I saw him come in. Let me just see here. There's Davron. Um, sorry, a few technical difficulties here. We'll kick off in a second. Davron, are you with us there?
I am.
Hi, welcome. Hopefully I can get your video working as well.
Just give me 1 second.
Yeah, I'd like to welcome Davron Chandadu. Davron, I'm going to ask you to also introduce yourself in a minute. Um, and then no one in the waiting room. And then have we got Ivan on the call as well? He also may be joining us as a panelist. Got Ivan. Here's there.
Jen, if you can hear me, please unmute Davron and also switch on his camera. He's not able to do it.
All right, there's a lesson in this is to always have a co-pilot and not try and do it all yourself. So hopefully Jenny's going to be helping me in a second. Davron and Ivan, your technology should be coming on live shortly. But yeah, like I say, big welcome to our clients who've joined today as we launch our Navigator tool. We've invited Simon and Vernon and some of the people who write in the financial press and have personal finance columns and blogs to sit in on today because it's one thing just listening to what we always have to say about the world, but this time around we'd really like it if some guests interrogated our thinking along the way. Davron and Ivan, whilst Jen lets you in, Simon, do you want to maybe just introduce yourself quickly? I'm sure most of our clients already know who you are, but maybe just a 2 minute recap, and then Vernon, I'll ask the same of you and Narina after that.
I'm a talker and a teacher. You find me just1lab.com. You find me on MoneyWeb, I mean Financial Mail, mostly talking investing, a lot of it around passive, but a lot of it around ETFs. I mean, I literally was in the Satrix 40 IPO all the way back in, was it December or November of 2000. To be clear, I didn't know what I was buying. I had a friend in Hong Kong who was like, "Ah, ETFs are great. You should buy this." And I still hold them, man. I think I paid $6 or $7 for them. They're now what, 100 and change. I've probably got $6 or $7. In fact, I've almost certainly got more in dividends over the time. So huge fan.
Yes, and you write prolifically, obviously, and do lots of media engagements around ETFs. And I see your website these days has got a huge ETF database too, Simon, which is fantastic. Yeah, so welcome. Always lovely to work with you. Vernon down the road at Currency News. Morning. How's it? Thanks for coming along.
Yeah, hi guys. I'm one of the founders of Currency News. We started in 2024. We kicked off operations in September of that year. And within 2 years, we were bought by a private company called Apex Partners. They also bought the Financial Mail and Mining MX from the ever capable and amazing David McKay, and combined the three publications into one. So now we the Financial Mail Group, and I'm one of the editors there. I cover mostly economics, and I help with the production side. I also have recently inherited Fox News, so that's one of the sections within the Financial Mail. I also cover personal finance there. I don't really write about personal finance because I'm no expert on personal finance. In actual fact, my personal finances are in a complete mess because I'm always delaying it and putting work and family and sports and friends and everything else before my personal finances, as I'm sure many of you do. And my area of expertise is more macroeconomics, interest rates, and all the rest. But I'm looking forward to hearing about what the tool is about today.
Great. And 10 out of 10 for the Black Friday guest this morning, Vernon.
Yeah,
Shame on the
actually,
rest of
this
us.
just to tell, can I tell you guys a story about this jersey? I got this jersey in 1999. As you can see, it's like
Yeah, I can
quite
see that.
old.
That's Bob's good stat.
I tried my hand at sports reporting for a little bit in the 1999 World Cup, and I was a ghostwriter for Joost van der Westhuizen during that World Cup, so it was quite
Fantastic.
something. Yeah, so cool. Yeah, this jersey has a lot of memories for me.
Great. I'm hoping Jen's got Devron and Ivan up and running. Devron, are you there?
I am here, but I can't seem to put my camera on.
Oh, that's a pity. Okay, well, we'll keep trying with that. Devon, we haven't had much engagement, but I've seen your website and some of the work that you're doing, and it's lovely to have a fresh face that we are chatting to around some of the things that we do. So yeah, thanks for agreeing to join today's chat. I don't know if you want to briefly introduce yourself to
Yeah.
our guests.
No problem. My name is Devron. I run a chartered accounting practice where we focus on specifically wealth structures and tax efficiencies in the market. I'm also a finance literacy content creator. So I do a lot of content around, and it's mostly video content around how to save your money, how to invest your money wisely, low cost investing. And I did this after working at one of the big four, two of the big fours in Johannesburg, and figuring out, I worked in the asset management audit section. So I figured out how the fees are structured and how things are working there. So I
Okay.
realized the public actually needs to know where their money is going, and there was a need for it. And I just share my experiences on social media and hopefully make an impact. And I'm excited to be on this call today.
Yeah, no, thanks for coming along, and yeah, looking forward to your insights as we move through this. And then I'm hoping that Ivan's also online now. Ivan, are you there?
No, he doesn't seem to be anymore, Gareth.
Okay, all right, that's a pity, but we'll get Ivan on another time. All right, I'm going to share my screen and start off with a present, just three or four slides just to set the context around this Navigator tool that we're going to take you through today, and then we're going to actually go through some live examples of it. And the reason for having some external people on the call today was really, as I said, I'd like them to interrogate the assumptions and ask us why we did it that way and not another way, and so forth. Narina, sorry, I didn't ask you to introduce yourself, but you're obviously well known to our clients. Narina Fisser, my co-director and advisor and strategist. So yeah, let me.
And co-pilot today on the Navigator journey.
And
How's
co-pilot
that?
and co-pilot on the Navigator today. All
Thanks,
right,
Gareth.
so yeah, just some slides just to kick off the context. Simon, as you say, ETFs have been in the market for some time now. In fact, last year, December, Satrix celebrated 25 years of the listing of its first top 40 product, which is wonderful that we've had this product structure in our market for such a long time. But one of the unintended consequences, sort of over the last couple of decades, is that there's been somewhat of a product proliferation boom, and we've now got over 300 what we would call exchange traded products. So not just exchange traded funds, but we're including exchange traded notes, actively managed certificates, and other types of listed products that retail investors can easily buy into their portfolio. And whilst that's a great thing on the one hand, because you've got all of this choice available to you, it's a bit of a dilemma on the other hand, because you end up with retail investors potentially being quite confused in terms of where do they start, which products to choose, and so forth. So one of our missions at ETFSA has always been to firstly enable investment into the ETF market. But then secondly, guide clients around which ETFs to buy and why, how to construct portfolios given various client goals and needs and so forth. We also run retirement pools where the collection of ETFs need to be compliant with Regulation 28 in the Pension Fund Act. And so really we're all about enablement within the ETF market, education within the ETF market, and building portfolios for clients using ETFs. And one of the big sort of focus areas over the last couple of years has been our model portfolios, where we take the whole world of ETFs and we say, right, how do we build our best house view for a balanced portfolio or a growth portfolio or an income portfolio? And so we've done that. Those portfolios have been running for some time. In fact, some of them are already several years old. Others are a bit newer. But we've now made these portfolios also available on our online platform. So anyone can really log in, create an account, and simply buy one of these model portfolios. Then the question is, if I have an online account, which portfolio do I use and why? And so we started drafting a whole bunch of literature around that, and we realized actually this is hell of a boring. No one's going to read this literature potentially. Let's try and do something a bit more clearer. And we started to build this Navigator tool, which is basically a decision tree that helps clients come out at the portfolio that's best for them. And we've confined it to 6 portfolios. And I mean, we're obviously going to run through the Navigator a few times as we go through it, but essentially, this is somewhat of a risk continuum from income portfolios, so defensive portfolios, through to balanced portfolios where you have some equity, some bonds, some cash, and so forth in the portfolio, through to equity only or growth portfolios, and then international. So there's 6 in total, and each of these have got a different risk profile, different asset allocation, and so forth. And we're really guiding clients into which one of these portfolios, or potentially which combination of these portfolios, would basically best suit them. All right. And then when we think about putting portfolios together, we obviously at ETFSA, we both advisors and we asset managers. So we advise clients on their financial affairs, but then we also construct portfolios as investment professionals. And when you look at model portfolio construction, you obviously have all of the big main asset classes, equities, bonds, and cash, and property as well. And the goal always is to dial this asset class according to the client's goal on the one hand, but also dial the asset class so that you get the best return profile, and dial it in such a way that you're nicely diversified so that you're not tied to one particular outcome, that you have some local equity, some global equity, that you have different asset classes within the mix. So the pie chart on the left would be, for instance, just a very classic balanced fund allocation. In fact, this is the asset allocation of our balanced foundation ETF, which is one of the model portfolios, where you're 70% invested in equity, 20% bonds, and then 5% cash, 5% property. And then you can kind of see the expected return profiles from these. So global equities over time, you should expect to outperform inflation by over 5% over the very long term. In local equities, we're an emerging market. You would expect even more return from our local market because you're taking more risk locally. Then bonds is lower risk, but also lower return relative to inflation. And then lastly, cash. And so our goal really, as I say, is to combine these asset classes both from a correlation and risk management perspective, and to then also try and maximize returns for clients. So when we do this for clients, and you'll see when we go through the decision tree, there are kind of 4 key inputs that we're going to get to, and those relate to time, clients' risk appetites, whether they're looking for growth or income, and their ideas around international. And so it's 4 different questions, and then there are 3 different answers that you can give. 3 to the power of 4, guys, is 81 combinations. So those are the different combinations that you can get when you go through a questionnaire of this sort. So that you could conceivably have 81 different clients who walk through the door, and you'd be able to give them an answer from this decision tree. When we built the decision tree, we realized that actually we now are, without really realizing it, entering the world of automated and scripted advice, which in the world of the FSCA is actually a license in its own right. And so we took the added responsibility to actually apply for that license and satisfy the regulator that this engine that we're going to take you through, this algorithm that we're going to take you through, has been properly stress tested, and we can now advise a client without ever having met the client, basically through a bunch of automated questions to the portfolio that we believe best meets their goals. All right, so let me not hang on to these PowerPoint slides any longer. So I'm going to exit these slides and go straight to the Navigator. So stop sharing there. And again, my technology skills are letting me down here. Let me okay, so if you go onto our website, all right, so here you go. On our website, which hopefully many of you are already familiar with, you'll see the Navigator tool sort of halfway down over here. Unsure of where to invest, let's find an ETFSA portfolio that best matches your financial goal. Let's go. All right, so now Vernon, Davron, Simon, Narina, I'd like to really get chatty with you guys. I don't know who wants to jump up and put their hand up first to test drive this first, or we can do it collaboratively, step by step here. There's lots of different ways. But the first question that we start with is around how much a client has to invest. Not because we want to be snobby and give some people better treatment than others, but basically, the more you have to invest, the more investment options this is going to unlock. So the first question is, what lump sum did you have in mind? Vernon, do you want to start here?
Yeah.
Give it a
So
go.
yes, I was feeling rather cash flush, having
Okay.
and I was saying, okay, I'll go with over 25,000 Rand. And I actually played with a tool a little bit last night.
Yes.
So I went with over 25,000 Rand.
Okay, so let's do that. So over 25,000. So the background thinking here is that if you've got more than 25,000 to invest, we are going to build a portfolio for you that includes more ETFs, if that makes sense. Because if you had less than 25,000, then we've got less money to divide between lots of different ETFs that might, for instance, make up your international exposure. So that's the background thinking, by the way. So we can come back to that, but let's go with that. So thanks, Vernon. And then after that,
And then so I was in a risky mood.
yeah,
And then I said, let's do the great. Well, not risky. I wanted to stay in for quite a while, so I went with a great track.
okay.
I'm setting out for the long haul with distant horizons and plenty of time to explore.
You can see that Vernon is feeling positive ahead of the Springbok game tomorrow as well, Vernon. That's
He's also showing off that he's young, but anyway.
oh right, that's
No, 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 no.
that's true. But this this next step here, guys, around and Marina, around the time frame is absolutely critical in investments because if we go back to those slides that I showed earlier with the different asset class returns, yes, you get more out of equities, but the reality is with equities is you've got to be prepared to see through, say, at least one market cycle, which typically we say a market cycle is at least 5 years. It should really be much longer than that. But to be in equities, you've got to commit for a period of longer than 5 years. If you're less than 5 years, then we're starting to add more and more defensive assets to your portfolio. So that's the background there. We can come back to that as well. And I hope you like our funky language here, guys, making it truly South African in line with our brand. So Vern wants to go on a great trek. So he's chosen a longer term portfolio. You're setting out for the long haul with distant horizons and plenty of time to explore. And so there we go. Vernon, let's carry on with you, and then we can come back to the others later, and I'm sure we'll have a time to go through a few different options here. So next was your risk appetite, Vernon.
So, okay, just having recently bought myself a secondhand car, that actually is all-wheel drive. I also thought, you know what, let me try this. I love off-road drives through tough terrain for the best view. So what the heck, I went with that as well.
Great. In keeping
Yeah,
with the Springbok jersey, I like that.
yeah,
So
I'm going,
you have
I'm
you have
going
the
with
option of
drive.
a smooth, predictable path. So this is obviously talking now to market fluctuations, how volatile an asset might be. Um, can handle a bit of that, but also, I suppose we could say some koppies or dongas or some potholes is the other more appropriate analogy, maybe if you're living in Joburg. And in this case, Vernon chose the off-road drive, so we're going to click that one. And then the next was around income versus growth. So we had regular putt course versus braai at the destination. This is like when you sort of shouting at your kids to, be patient. We're going to get to a petrol station soon for lunch, or whether you've packed, a whole cooler box of stuff for the car. What did you opt for here, Vernon?
Dude, you're not going to believe me, but again, I'm going all the way. Best
All
of
the way
Bri
to the
or
best of
destination.
bright to
Yeah,
destination. I like
yeah.
that. Okay. And then this question is around uh, whether it's you have a preference for local assets or offshore assets or a bit of both. The swallow flying back and forth. Um, Given your
So
Springbok
yeah,
jersey, I'm now going to say Mzansi, huh?
yeah. So Sapphire Swallow flying back and forth. That's me, man.
Okay, all
Yeah.
right. I like that.
So,
Okay, so the middle one having some local exposure, but also global. So the narration here says you value exposure to both local South African markets and international opportunities.
mm.
Next. So here, by the way, you've answered now the four key questions that I mentioned. So we've already at this point decided on a portfolio uh, for you based on the time you've said, your risk profile, your preference for growth and versus income, and your preference for offshore or onshore. Okay, so we've already behind the scenes already selected a portfolio for you, but we need to test a couple of things here. So the one thing and the most important thing is the time horizon. Can you, Vernon, truly commit to this 5-year period that you have told us you're committing to, even if markets crash next week?
Yeah, I've been reading a lot about what experts like Simon had been writing. I think just a couple of weeks actually ago, he wrote on the FM that you just have to stay invested no matter what happens in the market. So definitely a yes from me.
Okay, super. Yes, and then do you have an emergency fund? And by the way, an emergency fund in financial planning speak, and very few of us do this, so you'll be forgiven if you don't, is to have at least 3 months' salary sitting kind of on money markets for if your geyser bursts or you have some calamity that suddenly requires funds. So the question here is, do you have an emergency fund in place, Vernon?
Yeah.
You do? Okay, great.
Yeah, I just robbed the garage that's
Okay.
just down the road.
Okay. All
Thought
right.
you were going to say
Well,
you
well
robbed Rob.
done.
Yeah,
Well
so
done.
I didn't have my rugby jersey on when I did it. Don't worry, guys.
Okay. And then the last question is around whether you consider yourself a beginner, an intermediate, or an experienced investor.
Yeah, I've never actually invested myself, but I have some experience and understand the basics of. But I would say I'm comfortable with different investment products and strategies. I've read up a lot about hedge funds and all the rest. So I would say I'm experienced, but having never traded myself, yeah.
Okay, great. Super, and that's the end of the questionnaire. And we're now going to see a reveal. Firstly, we need to, because this is now an official advice that we have given Vernon, we need to now send him his basically his mandate. So I'll just send it to myself, to my Gmail address. So this is now going to, we could do it to yours, Vernon. Do you want me to do it? Well,
Yeah,
let me
no.
not do that. I'll just work with work. Pardon? Would you say you would like to? Let me just send it to you then.
No, go for it. Yeah, I think
it's
I
my-
created a profile.
Okay, well, anyway, it'll send a new
No.
one to you anyway. Um, um, Tell you what, I'll just send it to my email, otherwise we can take forever typing.
Yeah, I don't mind.
Yeah. All right, and then there's obviously a mandate that underlies this. And once Vernon has given us his details and that, we're going to email him the recommendation, and now it's going to be revealed. So your result, Vernon, is basically the ETFSA Maximizer portfolio. And this portfolio is all about maximizing growth assets with the aim of reducing volatility, ups and downs, through diversified asset classes. It may feature short-term dips, drawdowns, and so is well suited to investors with a high risk tolerance and a long-term time horizon, which is what you gave us. So your investment journey is the iconic Camino. And sometimes you have to go for a walk of a lifetime. It's long but hugely technical, and you're obviously going to get this wonderful reward at the end. So the portfolio characteristics, it's growth focused, investment style, strategic diversification with an emphasis on equities. In fact, the maximizer is just a growth portfolio. It's got no defensive assets at all. So you're going to be in offshore equity, local equity, and property. So you can endure. You've got a high risk tolerance, and your time frame is 5 years plus. And then the geographical exposure is predominantly global with some South African exposure. So hopefully this stacks up, Vernon, in terms of how you thought about that journey we've just taken you through. And basically, you can now email this result to yourself, and on the ETFSA website or on our hub platform, or just if you contact us, we've got a whole bunch of information to do with the Maximizer portfolio. You'll see the fact sheet on our website as well. It's about a 50% portfolio, 50% global, 50% local. You can see that they're, well, actually slightly more global at the moment.
Yeah.
All right, so that's a typical outcome. So hopefully you enjoyed that. Let's start over and then give it another try. I don't know who wants to go next. Marina, how about you? Because I left you out of the introduction, which I'm going to be chastised, I'm sure, for the for the
No,
rest
no,
of the
you know
day in the
what?
office. I've got a fine waiting for me as I leave my desk.
Now listen, I want to keep you in the red with me for as long as possible, Gareth.
Okay,
So,
all right.
I would love to hear from Davron, and I would love to see
Okay.
Davron maybe test drive the system for us, if I may
Uh,
put you on the spot, Davron.
Darren, you there?
Yeah, I'm here. Sorry, every time I need to speak, someone has to unmute me.
Oh no,
Oh my
sorry, man.
goodness.
No, that's a pain. Let's
Yeah.
we'll work on that
Gareth, by
behind
the
the
way,
scenes.
you are the host, so you're the one who can actually switch on Davron's camera and you
Yes,
can
but
unmute him as well.
sorry,
So,
I thought we had multiple hosts there. Sorry about that,
no, I
Darren.
think
Um,
you're the main Pikkawyn. You're the
okay.
big Mukulu boss.
Yeah, all right. Davron, hopefully that's already given you some context. I guess the idea now is, and I'm expecting that all of you are quite risk-taking. Maybe, Davron, you can kind of think about some of the older clientele or more conservative clientele that you might help on your platform. Yeah, I don't know. It's up to you.
No,
How
no,
would you
it's
like to
fine.
drive?
Does it consider the fact that this question, does it ever consider the fact that you have investments in another institution?
Not explicitly. I
Okay.
mean, obviously, this is really relating to a fresh investment
Okay.
that you would be looking to make. I mean, I suppose that you could be potentially verifying this tool against another portfolio that you have, but it's got no immediate way where it kind of pulls in, your, I don't know, your RA from another provider or anything like that. I mean, perhaps one day we'll get there, but it's really about looking at money that's to be invested in our environment.
Okay, great.
Yeah,
Let's go for it.
super. So again, the question to begin with is this under 25,000 or over 25,000?
We're gonna start what? No lump sum?
So yeah, so all of this is on a lump sum basis. When you actually set up the portfolio with us, when you actually start the investment, there is
Yeah.
the option to do recurring investments into these portfolios. Again, it's a little bit tricky in terms of how much you're planning to invest on a recurring basis. Most of the clients who have recurring debit order investments with us are into sometimes our model portfolios, but very often into single ETFs because it's a smaller sum of money. If it's a 500 Rand debit order for argument's sake, it's very hard to divide the 500 Rand over a full model portfolio of ETFs. But when the model portfolio is itself represented as an ETF, so like our Balance Foundation ETF or our Oyster ETF, then we can do that. So
Okay.
to answer your question, it's a bit of both.
Okay, so let's go over 25,000.
Okay. And then we've got the time frame story again, which I think Vernon's answers probably gave some color there.
Yeah.
So from 1 to 3 years, which is relatively short term, to day trip of 3 to 5 years, and then longer term time periods
Let's
again of
let's go with let's go with I'm closing in on 40 and I need to save for my child's high school. So
okay,
3 to 5 years.
3 to 5 years, good day trip. When faced with investment ups and downs, how do you typically react? And you said you're a CA, Davron, so I'm assuming you're a little bit more conservative than
Yeah, let's
Vernon.
go. Let's go. I can handle some copies and dongas, so
Okay, all right.
because it's not too long of a time period as well.
Okay. And then planning your putt course. So your preference between uh, income generating assets and Marina and I actually had a chat before this because it's income in a sense, but what we're looking at here is like those assets that's like money market and cash is obviously regular income along the way. So too is listed property where you get regular coupons along the way. Dividend equities, of course, you do get regular income along the way, but it's a lower starting yield. So how do you think about your journeys, Davron, in terms of regular putt course versus buy at the end type of thing?
I think let's go with a bri at the end.
Buy at the end.
Yeah, let's go with a
Yeah.
bri at the end for the
So
next
that
5.
that basically means you focus on maximizing capital growth over regular income. The bigger feast at the end, the better. It's not the Stobie's car, that's for sure. We've always got some snacks and chips flying around, but that's great. And then your preference for local assets, South African-based assets or global assets?
Let's go 100% offshore.
100% offshore. So here you're drawn to the potential of global markets and international investment opportunities. Okay. All right. So here again, the algorithm, we've already worked out one of the 81 combinations that now meet your inputs, but we need to double check in particular the time period that you have indicated. If you remember, that was a middle time period of 3 to 5 years. So are you sure that you can fully commit to that time period? Yes or no?
Well, what would happen if you click no?
Good question. So if you were to click no, we need to now check the assumptions, because the worry that we would have as the advisor is that a client has told us that they're happy to invest for 3 or 5 years, but then after 6 months they realize that, oh dear, actually they forgot that money that they put into the school goal that you mentioned, Davron, actually that they need that money back, and as luck would often have it with clients, they need that money back at precisely the wrong time from a market's perspective, and they ask for their money back when the markets are weak. So we basically, if you say no, we basically say to us, this investment may not be suitable as you may need the funds earlier. Do you still want to continue? So you can override it, or you can go, so you can say yes, continue, or you can go back and say yes, or go back again if you really wanted to, or you can click a button and then speak to one of our advisors, and we'll make contact with you and explain why we've asked this question, the significance of it, and so forth. So here I'm assuming that you're comfortable to override it. You could go all the way back and change the time frame that you'd indicated and said, actually, it's not 3 to 5 years. If I'm honest, I might need this money sooner. And then you change the answer of which time frame to 1 to 3 years rather. Okay, so I'm going to say that no, I don't have it. Oh, sorry, that was the one before. Jumping around here. Okay, no, I may need access to this money before the end of the time horizon, but I'm happy to continue even though I've made that disclaimer. And then, do you have an emergency fund in place?
Say yes.
Okay, yes. By the way, this is probing essentially the same question around time frame, because if you don't have an emergency fund in place and suddenly you hit a pothole and you need to buy a new set of tires, and you now need to access that funds, well, then you're back into not being able to commit to the time frame. So if you said no, we're going to ask a very similar set of questions and suggest that you make contact with us. Okay. And then we've got your level of experience from beginner to experienced.
Let's say intermediate.
Intermediate.
Yeah.
Okay. And then again, I'll just fill in my details so it's a bit quicker. So we're now going to send you your mandate and your recommendation. And then submit, and up pops your portfolio of choice here. So you are in our Oyster portfolio, which is the ETF we actually launched earlier this year, which is a 100% global portfolio. And your investment journey is a global bucket list of hikes, probably sending you into the Alps or something like that. Because if you recall, you asked for 100% global allocation, You are globally minded. You primarily wanted growth assets. You had a moderate risk tolerance. I actually thought we had a 3 to 5 year time frame, but longer term, 5 years would be this portfolio overall. And
Yeah, no,
then
we did go 3 to 5 years because
Okay.
of the school fees scenario.
Yes. And then the strongly, and then, but so I think this is speaking to the Oyster portfolio itself. We've probably said that we're comfortable putting it forward. And then the strongly favors global markets. And so then it gives you the asset allocation with the view then that you can go onto the platform, make the investments, email the results, or speak to the advisor. So if you saw this and said, actually, I'm a bit surprised by this portfolio outcome. I just want to double check that, what it's all about, and I want to speak to one of the ETFSA advisors, then you'd obviously be able to do that. Yeah. So that's that outcome. Does it make sense, Darren?
Yeah, it makes sense.
Okay. Yeah, this portfolio sits in the global multi-asset category, so it's not 100% allocated, even though it's offshore. It's not 100% allocated to growth assets. We have typically around 20% defensive assets. That's its strategic asset allocation. So there is some risk management within it. All right, so I'm going to start over again. And Irina, since you're so gracious, allowing the guests to go first, shall we ask Simon then, or Simon, you've been very quiet.
Absolutely.
Okay.
I want to do
Let's see
one.
if you
I have an
can. Let's see
idea
if
here.
you can act your age, Simon. Come on, you now.
No, I'm very
you
old,
claim
so
that
I
you're
plan to
old.
do it accordingly.
So please act your age.
And my wife has gone back to varsity, so I want to take a sabbatical. So we'll say over 25,000.
Okay. All right.
But I want to do something really short term here. I want to look at more the sort of the shore left, the 1 to 3. In other words, if my wife's back at varsity, then it's only fair I should be at the beach, right? I mean, that's seems to fit.
Yes.
Which means that like no one's going to pay me to be at the beach, so I'm going to need to generate some income from this.
All right. So that's 1 to 3 years short left.
Yeah.
Now, the interesting thing about that time frame, Simon, behind the scenes, and just a confession as we go along, once you put that time frame in, you constrain the asset allocation significantly, as you would know, Simon, because we would now be very reluctant to put growth assets in it because you're at the beach, as you say, you need the income, you might need the capital back quite soon as well. For this holiday that you're having. So the significance of that time frame that you selected basically constrains the growth asset allocation. Yeah.
Yeah, I mean, I would want the smooth, predictable, because
yeah.
I want cash every coming in sort of regularly that I can sort of bank on.
All right, great. That aligns with the time frame. Okay, and then local versus offshore. Oh, sorry, this is Putco. So income.
So regular, regular
Yes.
along the way.
Yeah, so this would be regular along the way. Again, consistent with your goal. And then the local.
The local part, I want Mzansi for the win because the point is that I live in ZAR. So I want to invest in ZAR because of the shortness of the period.
Yes.
Yeah, at the moment, the rand is doing some crazy things and it's about to break into the 15s. And I don't want to be at risk of currency. So if I'm spending ZAR, I want to earn ZAR so that I can match the two together. If I've got time on my side, it's less of an issue. Vernon had decades. He can handle the rand doing crazy. So I need Mzansi for the win so that it's ZAR for ZAR.
Sure. Makes sense.
Perfect.
And then, so again, at this point, we've now chosen your portfolio. We want to check that you can leave the money invested for the full period. In this case, because you've actually chosen already a short-term portfolio, it becomes much less relevant because
Yeah.
you're in an inherently defensive portfolio, but we need to check this all the same.
Yeah, no, I can leave the cash. I'm going to trust it.
Okay. But let's say we said no, because now you are at the beach and you might get money back. So if you were to say no, remember it was that question that we had earlier where we
Yeah,
said
yeah.
this may not be suitable. So yes, it's also going to ask you whether you are a beginner, intermediate, or experienced.
Well, I've been surfing a long time, but I'm still a beginner surfer. Oh, investing. I'm experienced investing.
Experienced investor and experienced surfer, from what I know. But there you go.
I've done lots of it, but still a beginner.
Okay.
The
All
T's and
right.
C's.
Okay, great. Okay, so I'll just fill in my name again. So submit and it builds your portfolio. And it's the ETFSA income portfolio, which you would, I think, be expecting. This portfolio plays it safe. It's low cost, local with mostly South African ETFs, and focus on ETFs that earn you an ongoing income. It's ideal for investors with a short-term time horizon. So the investment, it's a neighborhood power walk. Sounds good. You are looking for returns, but you want them to be predictable. With this portfolio, you're getting your steps in, you're keeping it close to home, and you're never far from the corner shop in case you need some fuel for the walk. So the characteristics is that it's conservative, stable, it prefers predictable income streams, it avoids risk, it's for a shorter term time horizon, and it's primarily South African markets. So the underlying portfolio here, Simon, as you can imagine, is all of the income ETFs that are now available in our market. And what's really interesting there is that there's been a huge amount of product development in recent years. We've got a whole bunch of active income
Yeah.
ETFs now that we
I
can
wanted
use.
to ask about that because
Yes.
it's the one space when I look at SPIVA, the Standard & Poor indexation versus active. Sorry, yeah, and so to be clear, the active gets beaten by passive, hands down in the equity space. But when we look at income space, it seems that you can actually generate alpha in income. So do you sort of focus more? I mean, there's those 91. There's tons of them. Do you focus on passive, or do you bring in a whole bunch of sort of the active ETFs in here?
We're very happy to use active ETFs in here, especially because a lot of opportunity in the interest-bearing world isn't available in index form at all. So you have, bank credits and corporate credits and other types of credits that you can't buy in a simple index thing, like you can the Govy index. And even within the property allocation, we very often use some of the smart beta products available where you get some slightly higher yield out of it. So this portfolio at the end of the day would be a very income-centric portfolio where we would try and get you the best possible yield out of the portfolio. There may well still be some capital growth. I mean, you've seen bonds in the last couple of years actually performed really well, as have listed property, but it's going to give you a strong return profile from that perspective. All right, great. Davron, Vernon, any comments at this point? Is it kind of making sense? Or there parts to it?
Sorry.
Yes.
Sorry. So let's say Simon is 50 years old. He doesn't understand his tax law, but he goes this route. Is there a way?
Yes.
Now, we haven't asked him, what's your tax bracket, Simon? Because if you go this route,
Yes.
you're going to be 100% exposed to the tax man.
True.
Yeah.
True.
So, is there?
Yeah, that's fair enough. We haven't brought tax into your marginal tax rate into the equation, and I guess you're probably touching on the differences between the real human advice, where you're going to pay a bit extra and have a proper human advisor who's going to get into some of that detail around, what assets are on your company name, your name, the respective marginal tax rates, your estate planning, all of that. At this stage is just looking at portfolio allocation, but it's a very, very good question because this would be, from a pure tax perspective, pretty tax inefficient because you're going to earn a lot of interest income. You do get some interest exemptions, of course, But yes, from that perspective, that's a valid point.
Okay. No, I just wanted to know if there was a thought behind it because of,
No,
when we're clicking, what time horizon and what age it is, and it should be dependent on his tax bracket as well. Because
quite right.
someone younger
Right.
going into interest-bearing funds, they probably won't have the same lump sum as him. So
Sure.
Mm,
No,
mm.
that's fair enough.
And Gareth, I'm assuming that this is part of my discretionary portfolio rather than either being put into a tax-free or a
Tax-free.
Reg 8.
Yeah. So all of this can be put into tax-free accounts. So we've got different
Well,
portfolios.
yeah.
Sorry, Narina, why
No,
don't
I
you?
was just going to mention the amount of money that you put in obviously might influence that. So the portfolios themselves are suitable for tax-free assignment, but of course the amount
Yeah,
that
the
you
limits.
do is going
Yeah.
to largely limit that.
Mm.
But I think it may be partly also in response to Davron's comment, which is very valid. All along this journey, it's been very important for us to remind investors that they have access to human advisors. We want to try and simplify the journey for the person who knows what the objective is, what they want to do. But if at any point in time you feel I need to speak to an HI rather than an AI, there's a human advisor that can, with human intelligence, that can help you through that journey. So it's really about facilitating a journey like a navigator, like a GPS that you would have, but there's always the human co-pilot available should you need to actually ask more detailed and relevant questions.
All right, great. Narina, I think we've got time for you to also test drive it. And I know it's going to happen now. You're
So, Gareth,
going to try and
no,
break it, which I'm looking forward
so,
to.
sorry, Gareth, actually, we've got a couple of questions in the chat, so I'd
Oh, shall
rather
we do
like to
that?
respond to the questions. I'm happy
Okay,
to
let's
do
do
that.
that.
I just want
Okay.
to maybe just further to because I think what we've alluded to but haven't really demonstrated is what happens when some of the choices that you make are inherently in conflict. And we sometimes find that, like Simon has come in now and, for example, said, yes, I want the low risk. Yes, I want the regular income. Yes, but then he's not Mzansi for the win because Simon is not Simon who understands that if I'm earning in ZAR and spending in ZAR, I need to have my assets also in ZAR and says, oh, no, it's got to be all offshore. That's an inherent conflict. The risk that you bring to a portfolio by having it 100% offshore versus an objective of I want this within a year and I want income in terms of that are inherently in conflict. And that's part of the system also, that it will highlight some of those conflicts to you and say, this is inconsistent. And again, guide you through the process of where you need to adjust maybe some of the answers that you gave, or then direct you to an advisor who can take you through that conversation. So I think that's really important to understand that this is a tool, but it's certainly not going to be a comprehensive human advice process along the way. And Sarintha in the chat asked, I think, a really great question. I'm so glad that you did, because it says the question regarding how familiar you are with investing, depending on which one you choose, does it change the portfolio options? And Sarintha, no, it does not. The portfolio options are designed around your objectives, the four important questions that you answered, and then the fifth one being the amount of money that you've got to invest. So it is the most suitable portfolio advice options given what you've got. The question around things like your emergency fund, like your ability to stay the course, like your experience that you've got it, that's more part of almost the I don't hate to call it the compliance aspect of it, but because we generate a record of advice at this, these are the sort of things that need to be recorded in terms of that, to say we did take into consideration or did ask the question and there was the option in terms of speaking to a human advisor. And partly then in response also to Davron, this is very much referred to as a limited record of advice. This is not comprehensive financial advice, which is what you would have when you go through a full financial planning process, take all assets into consideration and so on. It's a limited record of advice, really earmarked for a particular objective, a particular sort of allocation of what you want out of your overall portfolio. And this is now going to lead me to Dirk's question, because Dirk says, as a potential new investor to ETFSA, this appears to be a useful tool. For us as existing investors with ETFs, how do you see this Navigator tool take our portfolios into account and from there lead to possible shifts in our portfolio? Dirk, I love the way that you're thinking about this. In other words, not just a siloed individual portfolio. And the way I would think about this, if you want to use this type of tool on a broader basis, on a bigger basis in terms of your overall discretionary investment portfolio that you've got, is to use the tool to effectively give you sort of the target destination portfolio, if I can call it that. And then to look at your existing investments that you have, your existing portfolio, and say, where's the gap? How am I going to get from where I am at the moment to where I ultimately want to be? And what do I therefore need to do to adjust my existing portfolio to get me to that destination that I've designed? So although this is primarily meant for, sort of as I say, a standalone objective with a very specific characteristic sort of base to it, you can certainly still use the tool to help you define your destination as you would want to have it. But how do I get from my starting point to that ultimate destination? I hope that helps.
So, Narina, what you're saying, it almost narrows the field of all those options of ETFSAs out there. Or
Yeah, so
listen to me,
ETFs.
ETFs, yeah, giving you guys a free punt again. Well, yeah.
Vernon, absolutely. I think if we start where Simon started us to remind us about Satrix 40 that listed 26 years ago, just about now, we are finding ourselves now in this wonderful situation where we've got this massive range of options, but it brings with it the dilemma of choice. And we often find with investors that because there's such an amazing variety available, it leads to inaction because they're just overwhelmed. They don't know where to even start. And what we are specifically trying to achieve with a navigator is to help investors link objectives to investment choices. It's not always clear when you read the minimum disclosure document or the fact sheet on an ETF or any fund for that matter, how to link that back to my specific objectives, which we define on the basis of the time horizon, the risk appetite that you have, the desire in terms of growth versus yield in a portfolio, and so on. So it's for us using our expertise in ETFs. We are the ETF specialists. So to link that expertise to client objectives. The first step is asset allocation. We know that that's one of the most important aspects of constructing portfolios. But the much more, and that's already a hard job, but the much more challenging aspect then is how do I implement that asset allocation that I've identified by selecting specific ETFs. And that's really what the tool is designed to do. And we modify those over time if needs be, because the market changes, opportunity sets changes. Simon asked the question around the interest bearing and the bond ETFs and so on, where we are today compared to 3 years ago, 5 years ago. In those days, you could choose basically between South African bonds and South African nominal bonds and inflation-linked bonds. And that was pretty much it. Now we have a much broader variety. So it's all good and well to say, oh, I need bonds or I need interest bearing, but exactly which ones and how much of which and so on. And that's what the tool is designed to help you navigate, because it's not your area of expertise. We don't expect you to know which to select. We try and help you bridge that gap.
Yeah, thanks. And I'm mindful that we've just nearly on an hour now for the webinar, so I don't want to keep everyone unnecessarily. I don't know if there are any kind of closing comments, Vernon, Simon, Davron, that you'd like to share with us. Simon, anything from your side?
You're on mute, Simon.
That part unmuted. I like it. I remember the mad rush to robo advisors about a decade or so, maybe a little bit ago, and everyone kind of ran away from it. And I never quite understood why, because, and I think I get some of it, because I think we were trying to make it all, Narina, to your point, sort of AI and completely remove the human component from it. And I think it's much more relevant now in, as you say, plus 300 products. It's not just how do I pick which S&P 500 fund, because there are four of them. It's how do I pick my global core fund? I mean, is it S&P? Is it the All World Index? I mean, those sort of it's become harder and harder. And for many people, the ability to get someone on the line is hard. So I like it. I think it's great.
Simon, if I may just, sorry, Vernon, just to respond to what Simon is saying, you're absolutely right. Robo-advisors were all the rage and then it just fizzled out. What sat behind those robo-advisors were effectively mathematical and statistical models. It was using the past performance of those investment instruments, let's assume that they were ETFs, and was their historic returns and their correlation and lots of fancy maths to come up with some supposed optimal portfolio combination. But it never really linked you back to what are just my ordinary objectives as an investor. And I think that's the key difference here for me, and why I prefer not to even refer to this as a robo-advisor. For me, this is about scripted advice, automated advice, a guided architecture to help the client navigate from my objectives and my needs to how do I actually implement it.
Yeah. And I feel a lot more comfortable being stupid with an AI bot than with an actual human. And then learning a little something along the way before I actually ask questions or appear before a financial
I
advisor.
must introduce you to my AI bot. My AI bot doesn't suffer fools gladly. It gives me a hard time.
Okay, no
Shouts
thanks.
at me.
Davron, your perspective on this, I appreciated the more expanded and enhanced questions that you were asking. Do you see the role for a tool like this in the bigger picture of how you would consider financial advice?
Yeah, I really do. I think there's a lot of confused people on social media at the moment. And there's, as you guys were saying, there's thousands of different funds that we have access to. And just having some sort of roadmap and guidance like this within a few minutes is amazing.
Yeah.
Awesome. Love it.
Great.
Thank you.
I think we can more or less leave it there. Thanks everyone. Rena, sorry we didn't get into your choices. I know you were going to try as you may to try and break the system with you see what you can have clients, of course, that want maximum growth and are completely conservative and only want to invest for 1 year and that sort of thing. So you're going to get some problematic answers for those people. But our guests were all pretty logical in their sequence of thinking. If you did have those mad combinations, you're going to see that there's some disclaimers that come back to you from the system to say, have you know that this is sort of conflicting with each other, and very often the portfolios are actually spliced. So if you were a bit schizophrenic and you said you wanted capital growth and long term, but also you wanted a lot of income, then we might have half of Simon's income portfolio that he got, for instance, combined with half of Vernon's growth portfolio. So yeah, I'd encourage you to play around with this. Please email us, chat to, and both Narina and I were part of the project team that kind of built this on a day-to-day basis. So we're quite close to these different AC1 combinations. We literally poured over them and approved each one individually. So yeah, so it'd be lovely to chat to you. And thanks everyone for your time.
Thank you.
Thanks, guys.
Thanks very much. Thank you.
Thanks, everybody.
Bye.